All right, we on. All right, guys, welcome to Finance Fridays. We come every Friday and I bring you an expert. I bring you someone who's proven, verified in their field to give you some free game. And today we have a very, very special guest, one of my mentors, one of my good friends. We talk offline about a lot of things that's going on in the real estate market, things like that. And one of the topics we always talk about is investing in real estate and building generational wealth through real estate. And Cam Webb is the perfect person to talk about this because he has a background in real estate and different facets of real estate. And he's actually done it, right? So we're going to talk about a few deals he's done or he's consulted with friends on doing. And he's going to bring that knowledge and information right directly to you so you can rinse and repeat and do some of these deals that are out here. Because as a community, we are sitting on the sideline watching other people build wealth, and it's time for us to get in the game and actually start building wealth. So before we get started, Cam, I'm gonna let you do just a brief introduction, and then we're gonna get into some of these deals and talk about the real estate market in general.
Thanks for having me. Yep, my name's Cameron Webb. I've been in the business for about a decade now. So I started out as I started as a broker. I'm still a broker, salesperson. I started with Marcus and Millichap originally, right out of college, and hustled my ass off to do a lot of deals. I've closed over 150 deals at this point. Now working with Berkadia, deal size has grown, but starting out, I was doing anything from really like 400,000 of a 4 unit up to $10 million. Now deal size is a little bit different. It's really in like the 3 to $200 million range.
Mm-hmm.
But one thing that I'm really passionate about is financial literacy and educating our community, helping my friends, and doing whatever I can to help out us build and grow our wealth. So I'll go over like a couple of deals that friends of mine have done, and I think we can get started there.
Yeah.
But I think in terms of kicking it off,
To, to get started, first let's talk about the real estate market today as a whole, right? So there's like in the real estate market, we're split in between. There's some people that saying we're too overinflated, wait on it to fall, wait on the bubble to pop. And there's a lot of people out there saying, hey, I'm not going to wait to buy real estate. I'm gonna buy real estate and wait, right? So I can get that appreciation. So where are you at on that spectrum when it comes to somebody it being their first deal, or even yourself, right? When it comes to buying a 2 unit, 4 unit property, getting started to get in the real estate game?
I think it's deal specific.
Mm-hmm.
Market conditions, like they vary. So over since the pandemic, we saw at least in DC Metro, values didn't really drop. They dropped 1%, which is pretty much nothing. So DC, it's also we have the government here. We have a lot of tech economic drivers that have been pushing the economy too. So in DC Metro, it's fine on a national level. The real estate values actually on single families boomed during COVID, which was kind of interesting to see. You saw a lot of people that wanted to stay in their homes and work, play, live in their homes. So you saw the effect of that in the real estate. A lot of more home buyers to get out of like the highly amenitized properties.
Mm-hmm.
But right now, where's the market? It's I don't. I mean, are we in a bubble? Maybe, but I think that historically, real estate value always goes up.
Mm-hmm.
If you look at it over just a 10-year or really a 30-year time frame, it's always going up. So I can guarantee you that, well, almost guarantee you that in 20 years from now, the real estate values are going to be a lot higher than they are today. And that's what I'm betting on. I'm looking back at history and I'm saying, okay, these same properties in DC were selling at half the value 10 years ago than they are right now. So, I mean, actually, like one of the deal stories that I'll go into is on a 4 unit that I sold to a buddy 8 years ago, and it's doubled in value.
Mhm.
So, a lot of different things to think about. Interest rates have been at historic lows. So even though they're rising, they've still been at historic lows. I think it's still a good time if you're in a sub 4% interest market. I mean, interest rate market, um, even sub 5% interest rate market. So at the end of the day, it's really deal specific. So you got to really look at, hey, how does my deal pencil? Meaning, can the income of the property support the debt and your mortgage payments? And I also always say to have in reserves, you want to have in reserves probably 3 to 6 months of mortgage payments. But you do that in the first year after you buy it by not spending that money that you receive.
Mhm.
So just keep it in the account for a rainy day or if something happens in the property.
Mhm. So when we're looking at getting into our first deal, right? The typical thing to do is, because I was a mortgage banker before I started my company, right? So me going into the business, I thought I was going to be talking to all these successful people, and they were going to know a lot more about buying houses than me. And I was 22 years old, and they're not going to know. I'm not going to know what I'm talking about. And it was exactly the opposite. I'm talking to people who are executives at companies, and they don't really understand how to buy their first house or how to buy a investment property, and I had to really walk them through. So could we go through a few different programs that people should look at when it comes to buying their first house? Because I think a lot of people are intimidated by that when it comes to any type of investment property or buying a property in general. But
Mm-hmm.
when we understand the programs that are there to assist us to buy our first property, then it'll give us a lot more confidence to go into that. So what
For
programs would you recommend new investors or new home buyers start to look into?
Perfect. So I am not on the residential side. I
Mhm.
don't sell single family homes or, but I will talk on that as I've helped people get into 4 units, which you can apply with residential financing. But FHA is a really good program that I would suggest people look into, and you can get into properties with as little as 3.5% down.
Yep.
Um, and then also NACA. NACA is a very good program. It's a little bit arduous in process, but you can get in with 0% down with a NACA through the NACA program, and I think it's the best loan product out there. It's just, again, the process takes a while,
Mhm.
and it can be annoying. I've heard. I haven't gone through it, but from a couple friends that have done it, they're just saying, "Hey, it's a long process. Just be prepared." But I think it's well worth it when you get your loan product. You put zero down, and you have a below market interest rate. Um, and actually, a deal that I'll talk about later was bought through NACA and made a buddy of mine a lot of money in the process.
Mhm. Yes, guys. So if you guys are just coming in, make sure you like and subscribe. I want to talk about four things before we get into your deal specifics. As a banker, one thing that all lenders were looking at when you came in, whether you're an investor or just a regular home buyer, was your cash. So basically, how much money did you have to put for the down payment or any other reserves that you need? Obviously, your credit. So a lot of people get hung up on credit. They say, well, I got a 730. I'm waiting on to get to a 750. Honestly, once you get above that 700, and then once you get above a 740, other things start to matter. So if you're watching this and you're at like a 700 or a 740, you should definitely be shopping and looking to grab some real estate, because that's a good that's a above average credit score. And then obviously we're looking at your income. If you are somebody who like to get paid under the table and you do a lot of these odd 1099 jobs, you're going to be hurt when it comes to applying for financing, because a lot of times, especially with the NACA and the FHA program specifically and conventional, they're looking at years of your tax returns. And if you're getting all this money under the table, that's going to hurt you. So you got to make sure your income is stable. And they're also looking at the actual asset that they're financing, so the property. So right now we're talking about 2 to 4 units, which is good for the investment products. I mean, for investment opportunities. But those, you have to make sure you look at that as an investment. But when you're going to the financing end of it, they're going to finance it as if it's a primary residence, especially if you're staying in it. So that's a good opportunity because one, you can make cash flow, and two, you can lower your expenses, your living expenses to zero.
And you also qualify because they see that rental income from the other rental units as your income. So you can actually qualify for higher purchasing power through, a 2 to 4 unit property versus a single family home.
Yes,
So that's also another huge plus with 2 to 4 units.
yes, that's very, very important. I'm glad you said that because a lot of people may get discouraged when it comes to that. They hear I'm buying a $300,000 house or 400, $500,000 house because typically well, not multifamily, but 2 to 4 units are more expensive, even in the same location, in the same areas as a single family home. But that income is counted, so that's a real good point.
Mm-hmm.
So let's get into a few.
Also, real quick too, I know that NACA, they're a little bit more lenient with your credit score.
Mhm.
So I think that my buddy had around like a 580 or 600
Yeah.
credit score when he did his NACA deal.
Mhm.
But I do know that you have to have a certain amount of savings for the property that you're looking to buy or whatever you qualify for. So cash on hand is good to have through NACA. You just don't use it up front on the acquisition. But I think they want to see about 3 months of mortgage payments that you have in reserve. So in
Mhm.
your bank account.
Yes, that's very important. Again, we talked about cash, credit, income, and the collateral, which is the actual asset. So don't try to over deliver on one of those aspects because if you sit back and wait on you getting an 800 credit score, then you probably are lacking in some of the other areas like savings and your income, and you're not going to be able to qualify for it. So you don't have to be great; you just have to be good enough to actually get approved for some of these programs we're talking about. Okay, so let's break down. Um, for one, why buy a 2 to 4 unit versus buying a single family home? So let's talk about that.
I think it makes a lot more sense because in buying a 2 to 4 unit, you're subsidizing your mortgage payments, or you might be living for free. So if you buying, for instance, like a $400,000 property, if it's a single family home, you're on the line for that mortgage payment every single month. If you're buying a $400,000 property that's a duplex and you're renting out the basement unit, or that or just whatever other unit. Maybe you're living in the basement, you're renting out up top,
Mhm.
but you're getting that rental income from your rental from your tenant, and it might be, I don't know, let's say it's $1,500, but that $1,500 is going towards your mortgage payment, and on a $400,000 property, what would we say? It's probably, let's say it's at 3.25 on a $400,000 property. You're probably around like 2,800 to 3 G's a month.
Mhm.
Um, so, you're living for, instead of having the 3 G's that you have to cover yourself, you're paying $1,500, which is going into principal and interest.
Mhm.
So, as you're building, as your property is appreciating and growing in value, you're still only paying that $1,500 because you have a tenant that's paying the other half of the mortgage for you.
Yes, that's very important. Okay, let's get into one of your deals. I don't know which one you want to go through first. First, let's go through that one that you said your the one you helped your friend do,
Mm-hmm.
and it appreciated. So the one you did 8 years ago and it appreciated because I want to go over that one because a lot of people are looking at the market today, but these same deals are here now because in 7 or 8 years, it's going to be another story about another investor or another purchaser actually got in at these times. So let's break down that deal.
Yeah, you don't want to miss out. I mean, I have countless like older clients that are talking about, hey, this property is too expensive now. I could have got it 10 years, 20 years ago for a quarter of the value or half of the value or whatever it may be. But then you push forward another like 10 years, those same guys are saying, damn, I should have bought that property.
Right.
So just know real estate is continuously appreciating. There's only so much land, especially if you're around like major like MSAs, and you have a lot of different drivers that are kind of coming to your neighborhood or just different economic drivers that are pushing value. So let me go into a 4-unit that a buddy of mine got in Congress Heights, DC.
Okay.
So he got this for $400,000. I sold it to him for $400,000. It was 4 units, all 2 bedrooms, 2-bedroom, 1-bath units. And so he did nothing in there. He bought it with NACA financing. So he put down 0. He had I don't remember what his interest rate was, but I think it was around 3%. And I think, with NACA too, you don't have PMI. So I think he was
PMI for the people who are wondering is private mortgage insurance. So whenever you're buying a property, you have less than 20% equity in that property. Your if your loan to value is less than 20% that you actually own, you pay mortgage insurance to cover the risk of the lender. And on FHAs or other government programs like FHA and USDA, you always pay PMI. So just keep that in mind.
So with NACA, there's no PMI.
That's crazy.
Which was great. So he was all in paying around, I think it was around $3,000 a month. And so on the units, I think they're renting around $1,500 per month. So he lived in one of the units, and then the other 3 units were bringing him in about $4,500 a month. So he, in coming in and stepping into, the shoes of a landlord, you do have different expenses. So you have repairs and maintenance, just kind of wear and tear, fixing toilets, light bulbs, maybe different appliances, some drywall here and there. And then you also, so one thing to do is you can put a management company in place. Management companies on those properties range from, it's a wide range depending on the market you're in, but I would say anywhere from like 6 to 10% of the rental income that you receive. But that's a way to kind of de-risk everything. If you get a professional management company, but I would say you need to kind of stay on top of them. The last thing you want to do is just be a very kind of hands-off owner. I think that after you build trust with the management company, they've been doing it for long enough with you, you kind of learn how they work. Then you can chill, but at the start, you want to be all over it and on top of it. This is your investment.
How much did you say he was getting each unit?
$1,500.
Okay.
Per unit, all 2 bedrooms. And it was about $4,500 a month coming in. And he was, you got the thing up. And so he was living for free. He had $4,500 coming in a month. And then his mortgage payment was $3,000 a month. So the difference is what, $1,500 there. Now he did have property expenses. He self-managed. So he just had repairs and maintenance. You have property taxes, insurance that you're paying for. But let's say that ran him about $500 a month between, the rest of the units. And that's pretty light, but he was running it himself. And so let's just kind of rehash this. He was living for free because the property, the mortgage was being covered by the other tenants. Plus he was making $1,000 a month. And that was his deal. He was just living and keeping up the building. But let me fast forward 8 years later. Today, that same property is worth about $800,000. So he got into the deal with nothing, no PMI. He had a below market interest rate at the time. He had really good credit, which was good for him. But he also bought a good property in a market that was rapidly appreciating. So the value of that property is $800,000. If he were to sell today, he would make the difference between the $800,000 purchase price after he has commissions, closing costs. Let's say it's bringing him to $750. and then minus whatever is left on that loan. Let's just say it was 100% left on the loan, which is he probably has, I don't know. The loan might be around like 350 now, but
Right.
let's say it's 100%. So he's still walking away with $350,000 from that deal. And then he can go ahead and do a 1031 exchange and do another property, which is a whole nother thing, but it's taxed. You're deferring your capital gains. So you're not paying your capital gains. But you're deferring that into, the next transaction, but you can keep on doing 1031 exchanges. That's diving into something else. But the point is that he made $350,000 over an 8-year period on the appreciation. Plus he lived for free. Plus he was making roughly $1,000 a month. So he had $12,000 a year of passive income, lived for free, and made damn near $500,000 off of just this one deal.
Yeah, and this is through the NACA program, like you said, with the 0% down. So pretty much everybody watching this could Google and look up NACA and research it, and pretty
Yes.
much all of them will probably qualify for it. And again, like he said, it's a little more work. However, if you're going to make any type of progress in your wealth journey, it's going to be work, right?
Yes.
So you may as well start doing the research now. And then, like you said, he got in. He didn't have an 800 credit score. You said he had a 580, 600,
No,
right?
no. My buddy had a good credit score,
Oh no, you said he
but
did had a good credit score, right?
yeah, but he didn't put down any money.
Okay,
He
yeah,
put
okay,
down,
that's the one. And remember, we talked about you need cash, credit, the property, and income. And once you figure out the ones that you are strong in, you can start focusing on the other ones, right? So if your credit is not great right now, you can focus on that, get that up 50, 60 points, and then start moving on to the other areas that makes more sense for you so you can actually do a deal. Because I think a lot of times we overanalyze, right? And we sit back and we say, yeah, I'm going to do that. I'm going to do that. And we talk about it. And a lot of times when you're on the sideline, you feel productive just talking about stuff, right? Which is why,
analysis paralysis.
correct, which is why I do some of these things, because it's like, yes, we're talking about it, but I want to encourage people to actually go out and do some of these deals. So,
And you got to
after,
start the process, because we're talking like this could be, call it 3 to 6 months of going through the NACA process.
Mhm,
So, I think you have a consultant that you talk with that's there and you meet with, and they make sure that you're in line with like your savings, and that you also know what you're signing up for when it comes to like a multifamily property,
mhm,
like a 2 to 4 unit, and what it means to be a landlord. So really good program. Again, it takes time,
mhm.
but start it. It's going to change your life.
Yeah, and I think a lot of people just talk themselves out of it, which is why I push this information. So, and I bring people like you on there to talk about it. Let's talk about like when buying your first property, right? Okay, so we get into this NACA program or FHA program and we move in there because we have to stay there, right? But let's say we get the FHA loan and you only have to stay in an FHA loan as a primary residence for 1 year. So after the 1 year and you move out, right? And now you got this asset cash flowing and things like that. What do you do for your next deal? Because after that, you can't go get 2 FHA loans, or more than likely, you probably can't get 2 NACA loans, right? But let's say we're trying to build up a portfolio. What are some other ways we can get financing when it comes to, let's say we got a deal? Is it like hard money loans, working with investors? Let's talk about some things, some unconventional ways to get financing after we got the conventional financing through NACA or FHA.
I'm not, again, heavy on the residential side,
Hmm.
but I do know that a buddy of mine's doing it right now where he's getting multiple single family homes and 2 units as investment properties, and he's only putting down 5 to 10%.
Hmm.
But they're just conventional, loans. So not
Okay.
FHA, conventional loans. Really, at the end of the day, the lender and they just want to see you pay your mortgage payment.
Mm-hmm.
So, you know, I'm not saying like, so sometimes people might not be in the property for a year, or they might move a little bit sooner because
Right.
their life circumstances changed, and there's nothing wrong with that. So as long as you're paying your mortgage on time,
Mm-hmm.
you should be straight. So
Yeah,
um,
that's a real good point. I want to let everybody know whenever you're applying for financing, whether you're working with an investor or you're working with a traditional, conventional FHA loan, whatever, the name of the game is to lower your risk profile. Right? You don't want to come in there and look like you're going to be somebody who's going to be foreclosed on 6 months into the mortgage, right? Because these companies, they like to do the mortgage, package it up, and sell it. So they don't want to go through the process of servicing your loan, and now they're going through the court process because they can't just come and take the keys from you and put you out. They got to go through an actual process, and they got to pay more people. So the name of the game is to make your profile less risky, and we can talk about a few different ways to do that. So for example, um with conventional financing, we look at, and when I say we, I'm talking about the banks and mortgage companies. They look at 3 months of your business, I mean not business, of your bank statements, right? So with 3 months of your bank statements, they're only looking back 3 months of your bank statements. So let's just say you get a gift from your family members or friends, right? You put that money into your account, and then you let that money sit in your account. Don't go spend it. Don't go buy Gucci and Louis, whatever. Let it sit and mature in your account. So when you are going to apply for financing, it shows that you had 10, 15, $20,000 in your account. So you can actually let that sit there, and that could be qualified as reserves. Right. So a lot of times you don't have to be in the best financial position, but if you're around people who are willing to help you out, they don't even have to give you the money. You just literally have to reposition the money. And there's a lot of stuff that other communities are doing, and I know this for a fact. Like, these communities are doing this. So these are some things that we have to do. Lower your risk profile whenever you're working with any type of loan company, any type of financing company, and that is going to increase the probability that you are actually going to get financing, whether it's conventional, NACA, or FHA. So let's talk about the second deal that you had. You want to talk about that deal?
sure, this is actually a deal that another friend did. It's the same guy that's like continuously buying up houses and 2 units and whatnot in DC. But um, this was a property in Columbia Heights
Mm-hmm.
that he picked up for $650,000. It's a 2 unit, so there was a 3 bedroom up top and a 1 bedroom down below. Um, and so in there, he also, so one thing that I always say, whether it be buying a big multifamily property, or it's a single family home, or it's a 2 to 4 unit, is you want to try to add value. So it's, and essentially what we're talking about, as other people have called it, the Bur Method. It's buy, renovate, refinance, repeat. That's basically the process that a lot of my clients do, that a lot of my friends have been doing to build wealth, and it works. I just recently it's been coined the Bur Method,
Mm-hmm.
but yeah, I mean, in the renovate piece, you're renovating it so you can get more rent. So you're bringing it from like a decent product to a great product to attract that renter that's going to pay you more money for the rent. Um, and so another piece of that too, which is a really good way to do it, is adding value in the property, and it's either making it a lot nicer to appeal to that different type of tenant that's going to come in and pay you more,
Mm-hmm.
or it's also making it nicer, but it's adding value in, like, maybe you can add a bedroom or something like that. So and that's what he did in this 2 unit. He turned that 3 bedroom up top. There was enough space that he took out of actually like the living room, that he made into the fourth bedroom.
Mm-hmm.
So he turned a 3 bedroom into a 4 bedroom up top. The 1 bedroom, he kept it the same. But as I let me elaborate a little bit more on that 3 to 4 unit. 3 bedroom to 4 bedroom conversion.
Mm-hmm.
It was a simple conversion in DC. You just have to have 70 square feet, a window, and a closet. So
Okay.
the window has to be 3 feet from the ground, and the closet. So he was able to find that space to do that, reconfigured it a little bit. I think he spent like maybe $8,000 in addition to
Mm-hmm.
do that. But long story short, made it happen. He's renting out to market rate tenant right now, but he's able to get $4,200 a month from the 4 bedroom.
Mm-hmm.
And then on the 1 bedroom, it was 2,000. So he was totally he was getting around $6,200 a month
Mm-hmm.
in rent. And he put down 5%. So on 650, 5% is about 32,500.
Mm-hmm.
He also tied in closing costs into the deal. So he negotiated actually a little bit higher purchase price, which ended up being $650,000, in exchange for the seller giving him a credit for closing costs. So this is like a really good strategy to use when buying, to kind of come out of pocket with less, because things that you don't talk that are not mentioned all the time are, hey, what's the cost of closing? There's transfer, there's recordation. So being able to tie that cost into the transaction, and have maybe you pay a little bit more on your loan, but that's paid for up front. It makes a lot of sense. So he did that.
Before you move on, I want to talk about that, because that's a very, very important piece, and I don't want people to miss that. If you're buying a property, right, and you say, let's say the property is 650, like he said, and you opt to pay 660 and get that $10,000 in seller concessions, because usually the seller concessions max out at around 3 to 5%. That's the maximum you can actually do with, especially conventional loans. If you get that extra money, that only adds about, so every $10,000 you finance on a mortgage payment is roughly about an extra $50, right? So your mortgage payment goes from, like you said, what was his mortgage payment?
I think he's paying. I think his total mortgage was around 4,000.
4,000. So you go from 4,000 to $4,050, but you get $10,000 in seller concessions that you actually don't have to take out of your pocket. So which one is more valuable at the moment? That $10,000 sitting in your bank account for the reserves, or just for 3 to 6 months of your mortgage payment, or you lowering your monthly payment by $50? Right? So that's another way, and I'm glad you brought that up. That's another way a lot of people can keep more money in their pocket for reserves. Do these deals, put 3 to 5% down to make their risk profile lower, so they can get the financing and still actually have some money in the bank, so they can do the renovations or whatever they need to add value to the property. And
Yeah,
I'm
I
glad
mean the biggest thing is like, hey, what's your cash on cash return? That's what people talk about all the time. Well, that's what I talk about all the time. But cash on cash return is, how hard is your money working for you? So I would much rather pay $50 a month or $100 a month versus coming out of pocket on $10,000, because I know that off that $10,000 I could probably invest it, and I'm hoping to get the cash on cash returns that I'm always shooting for are 20%.
Mhm.
But if I can make 20% cash on cash return, then I'm golden. So, and so I'll pay again 50 to $100 a month. If I'm making, on that 10,000, it would be $2,000 a year. And that would be about $170, 160, $170 a month.
Mhm.
So, in other words, my delta is what, 60 to $100.
Mhm.
So you're making more on your money.
Right.
In other words,
Yeah,
uh,
yeah. No, go ahead.
But no, that was it on just cash on cash, and that's what that's what I'm looking at, and basically every single investment that I do has to be a minimum of 20% cash on cash return.
Okay. Yeah. So a lot of people talk themselves out of investments, right? So I'm glad you brought that up because it's like a lot of people want to hit things out of the park, and you're saying, "Hey, I just need a 20% return." You know, if it goes higher than 20%, congratulations. If it's a little bit lower, okay, we can work on that. But 20% is a lot more realistic than trying to triple and flip your money. Um, you know,
But
with something that's a lot more riskier.
I will say that it happens over time. And like I'm saying, in real estate, I want a 20% cash and cash return.
Correct.
So in real estate, I want my money to be making 20% on itself. But keep in mind your property is also appreciating. So just like my friend who bought the 4 unit 8 years ago, and it's now worth double. He's essentially made $350,000 to $400,000 of equity.
Hmm.
So his cash on cash return on that deal, the true return on that deal was what about? I mean, he put down nothing, so it's really infinite. But if you would have put down $40,000, it would have been a 20x.
Right.
So, or I know it would have been a 10x. But something to think about, right?
Yeah.
Um, so yeah, I mean, but at a minimum, you want to see your cash on the cash that you put out make 20% of a return, and then you're appreciating over time. So real estate it gets prettier and better over time. So that number just keeps getting bigger.
Hmm.
So that's something to really keep in mind. But
We were talking about, you said we left off when you said he negotiated to get seller concessions so he could only bring the down payment, which was 32,000.
mm-hmm. So brought 32,000, closed it. Now he has mortgage insurance because he closed conventionally,
Mm-hmm.
and I think that the mortgage insurance might have been around like $400
Mm-hmm.
for that property. But
And on that, and that's a conventional loan, right?
right.
Okay, so guys, so on a conventional loan, you have to pay mortgage insurance up until you get to 20% loan to value. So that basically means after you own 20% of the equity, and the bank owned the other 80%, that mortgage insurance goes away. So this is a great deal for him because he put down 5%, right? He didn't bring that much cash to close. So over the years, once he gets to 15, I mean, once he gets to 20%, that extra $500 that he's paying in private mortgage insurance, it goes away. So that increases his cash flow.
Mm-hmm. Or because he added value, which is turning it from a 3 bedroom to a 4 bedroom. He's now the values now they'll refi. I mean, he's doing a refi,
Mm-hmm.
but that refi is based off of the same type of properties, meaning he's now being compared to 4 bedroom up top and a 1 bedroom down below versus 3 bedroom up top and a 1 bedroom down below.
Mm-hmm.
So basically, long story short, he added value, which ended up adding really the value on the bottom line for the property. So he bought it for $650, but I think it's going to value around like $850.
Mm-hmm.
Because that's just what other properties that are duplexes with a 4 bedroom up top and a 1 bedroom down below in similar condition in a similar neighborhood are selling for.
Mm-hmm.
So that's like a kind of a secret sauce of how to add value, increase the property value, get rid of your PMI on your refi. And you can also pull your money out if you like, based off the new value of the property.
Mm-hmm.
So, in a $850,000 value at 20%, it would be 680. So he can pull out all the money that he put into it,
Mm-hmm.
to be at that 650, that 32,000. He gets that back.
Right.
Plus, he can get another $80,000. I mean, plus he can get another $20,000 on top of it. taking him to, the total loan value of 680.
Hmm.
Now you still do have like your closing costs, so that's to keep in mind. But long story short, he can get back, he can pretty much 2x his money
Yeah.
in 12 months.
And another thing with refinances, the closing cost is rolled into the loan, right? Into the new financing. So what that means is if you own a property and you're refinancing it conventionally, you're not bringing that extra closing cash to close to the closing table, right? Pretty much a lot of times with a refi, you get money back. You don't bring money, right? Because that's the purpose of the refi. So I think that's very important. And he's doing conventional financing. So literally after he finished that deal and walks out with the equity, he can go on and do the next deal and apply for conventional financing.
Mm-hmm. Yeah, no, I mean I think that's the best part about a lot of these deals on the Bur method, is that refi piece. Because on the refi piece, you're able to pull out a lot of your money that you put into it. The goal is to pull out 100% of your money, and then do another deal, rinse and repeat. So you add value, you're cash flowing, and then you eliminate the PMI, which in this case, $400 could be more,
Mhm.
but eliminate the PMI, and then you're able to go back and do it again and do another deal. But I think that he was making around like 1,200 to 1,500 bucks a month residually off of that property.
Mhm.
But that's 1,200 to $1,500 a month that he wasn't making before.
Right.
And he has his cash back plus another $20,000. So now he's working with 50 grand, and he can go and do it on another deal.
Mhm.
I think his goal is over the next 3 years to build up to $10,000 monthly residual, so he can make $120,000 a year not doing anything.
Right.
But you want to set your goal, and I always say it's good to buy a property a year. If you can buy one property every single year, you'll be set. I
Mhm.
mean, everybody will be millionaires.
Yeah.
You buy one property a year.
Yeah, and I love that you said that, but um people have to buy their first property, which is
Yeah.
why we're doing this, because we want to encourage people to start investing. You got a business, invest in your business. If you got a good job, look at ways to make money outside of your job. And this is a great way, obviously through real estate, because you can't get to the second or third or fourth property if you don't buy your first one. So I really appreciate you for coming on here, bro. So I want to go over probably about 2 or 3 questions because a lot of people sent some questions when we posted this up on social media and Instagram and everything, saying that we were going to have you on. So a lot of people talk about putting your investment property in your LLC versus keeping it in your personal name. What's your thoughts on that, and what advice would you give to first time investors on some strategies to protect their investments, whether it is putting it in an LLC or not?
Well, with the residential programs like FHA, NACA, and stuff, you can't
Okay.
you can't buy it with an LLC, but you can put it into an LLC on the refi. So that's what you should do on the refi. Put it into an LLC. It's going to protect you personally. So if something happens and your tenant slips or falls, or they have a friend over that slips and falls, nobody can personally come after you.
Hmm.
If it's into the LLC, they can only go after the LLC. And then also you have a lot of tax benefits too from the real estate. So you have depreciation, but what a lot of people also will do is through their taxes, they'll have a bunch of write-offs, which is basically their lifestyle, but their lifestyle is also tied to their business and
Right.
keeping their business profitable. So you can get creative. I would just say talk to your CPA about that, but
Mhm.
you can get creative in paying a lot less taxes than you otherwise would.
Another thing, it was a common theme in the questions about like group economics. We always talk about coming together and building wealth. So what would you say to, you know, two or three young people who just got out of college, just got their first good job, or they're just starting to make profits in their business and they're looking to diversify, but maybe they don't have the $32,000 to get started on a property like that. Let's say they got 10. What would you say to two or three of them that wanted to come together and work together? Do traditional financing, is that frowned upon when it comes to multiple people working together on properties like that?
Partnerships happen all the time in real estate. In the private client sector, which is where I'm at, you see that a lot. But I will say that, if you can come together and do a deal, but on the 2 to 4 unit space,
Hmm.
or single family home space, I don't think you can come together as a company to do that. You gotta take the loan on personally. But
Yeah.
if you were going to buy something with a commercial loan, you're putting down 20 to 25%, and you can come together with friends to do that. But I would just say be careful also of like who you partner with.
Right.
You want to, ideally, I would say, find somebody in your community that has a lot of experience
Hmm.
in this space and has properties under their belt, to get started and learn from and be a mentee of.
Hmm.
You'll be able to skip a lot of the pitfalls that most people fall into because they've done it and they've seen it.
Hmm.
So, but also, make sure they have a good track record and that they're in good financial space, to even take you on as a mentee. Um,
Yeah. What another question a lot of people asked, and I don't know because we talk offline, but I'm not sure. But I wanted to make sure I asked you this. A lot of people talked about, like, let's say they stay in New York or a place like that where the real estate is really, really high, and even if they come together with friends, they can't really put $80,000 together to buy these properties. What about investing in other areas? So, what advice would you give to somebody if they're looking to invest? Outside of the areas that they live in. Would you recommend that, or
Yeah, I would say know the market. So you got to study the market and know the market. And you can find really good investment opportunities all over the country. It's just you got to study it and know it. So, you got to really truly be a student of the craft, meaning, and a student of the game, meaning, you need to know what the recent sales are. What are the property values? Why is the 5 bedroom selling for more than a 4 bedroom, or why is the 4 bedroom in this neighborhood selling for more than a 4 bedroom in a different neighborhood?
Mhm,
What's going on? What new big developments are happening? So you just really got to study the game, study that market
mhm,
to be able to make the best play. But, I'll also say we're talking about people not having enough money. This kind of goes back into budgeting. You know, Nothing happens overnight. Real estate doesn't. You're not going to become a millionaire overnight. This happens over years. So, you got to be consistent, be disciplined in how you live your life and how you budget. I would say live below your means.
mhm,
I think most people have the capacity to save anywhere from $500 to $1,000 a month, but they don't. Nobody really looks at what their spending habits are. They just spend.
mhm,
So know your rent. What's your cost of living? What are your Netflix, your Amazon Prime, the other things that you like, your gym membership, and then what stuff can you cut off of that? But everybody should sit down with a notepad and just plan out what their monthly cost of living is.
mhm,
Once you have that, you have your income, and then you have how much you should be paying yourself a month. If you want to build wealth, you need to start paying yourself so you can build up the cash that you need to get into a property. And this is just, I think that just goes for everybody. I do this myself. I've been doing this since I was 18 years old. So, that's just something that's huge that a lot of people don't do, but it's very important to do. And you're gonna, find yourself in a much better financial situation by literally sitting down, going over your monthly cost of living, and then you know going from there. But I'll also say, in terms of, hey, I don't have $50,000, I don't have $30,000. Look at NACA. NACA is NACA Financing. Google it. Go to their website. Call them, and that's a very good program to get into, where you don't have to put any money down. You can keep your $10,000. You can keep your $20,000 in your pocket. They want to see you have that money in your pocket as reserves for your property. So if you're serious about it, act, be in motion, stop researching, stop, talking, and do.
Mhm. Yeah, man, that's very, very important. So everybody watching this for sure should go and Google and check out what NACA is. And even if you're just making yourself familiar for it and talking to a consultant and figure out, hey, I need to, you know, hit my savings goal. I need to get my credit right. I need to make sure my income is documented. Things like that. You're better than you was yesterday. So, Cam, man, I appreciate you. Thank you for coming on. You're always welcome to come on anytime you get some time. I know you're a very, very busy person. So I appreciate this hour or two of your time to come and just share knowledge with our community. And we need more people doing this, man. So I appreciate it. Anytime you want to come on, you're definitely welcome.
For sure. I appreciate you. And like, let's just get everybody to start doing, let's stop talking. Let's start doing. So again, like, you're not going to hit it at the park on your first deal. You may not, but yeah, I can tell you that real estate's always appreciating. And as long as the numbers pencil out, meaning the property and the income is fully covering the mortgage or your debt payments, then you're straight, you know. But I guess the end piece is do it. Don't
Mhm.
be afraid. Failure happens all the time. I've failed countless times, but it only you only got to be once right to do it to crush it. So again, ending note: go pick up that property by the year end 2022. Get your deal, or at least be in process with NACA or another financing, but get your deal.
All right, man. I appreciate it. Thanks, man. I appreciate you coming on.
No problem. Have a good one.
All right. All right, guys. Yes, please like, please subscribe. Make sure you subscribe to this video. Share this with 5, 10 of your friends. It makes no sense to watch information like this and you don't act on it. So I want you to go act on it. I want you to go do your research. I want you to get your money right and everything so you can take your brand to the next level.